Hello and welcome to this week's episode for SPY Trader Now. I am your host. My name is Ken and our model portfolio is up 6.81% year to date. Our goal here at SPY Trader Now is to beat the returns of the S&P 500 buy and hold investor. That investor is currently up 13.14% year to date, and our goal is to beat them, and so we're lagging behind by about 5%. So we've got some work cut out for us because we want to beat that return. Here at SPY Trader Now, we do this with a very simple 3-position portfolio. To make things really matter, it only takes about 15 minutes a week of trading time in order to position this portfolio, which makes it a fantastic portfolio for people with investment capital. Now, I call my handle SPY Trader Now, but we do this with investment grade capital as opposed to trading capital, because the way that I trade the portfolio is a very conservative format, and you'll see that later on in the presentation. And that is how we roll. Here are some past results for SPY Trader Now model portfolio in 2022, up 21% compared to the S&P 500 buy and hold investor, which actually returned a negative 19% in 2022. And here's 2021 and 2020, doubled the portfolio. Fantastic. If you want to see how I do that, go ahead and hit that subscribe button, ring that bell to be notified, and smash that like button down for me right now. Thank you. Last week, the S&P 500 lost 1.42%. We'll go through the charts in much greater detail later on in the presentation. Here is the past trade that was placed on June 16th, and here's the trades that we made, and we'll talk about that during the presentation. But basically, on the 16th, which is this red candle right here, what I did was I sold an in the money covered call with a 417 strike. I actually rolled it out because we already had that play, but I rolled it out again starting on the 17th, and the market has been correcting since, which is good for our option, because when we sold it here, we got the premium in our pocket, and what's happening is that premium is losing money because it's a call option, it's a covered call option. So as the stock goes down, the stock being the ETF SPY, as that goes down, that option loses money. So when we buy to close that option, we're going to buy it back at less dollars than when we sold it for, and so we're going to be able to pocket that difference. We're expecting the market to come down and correct and then bounce from there. We'll go through that a little bit in greater detail later on. Here are some trades that we've made in 2023. If you want to see, and these are the latest trades, if you want to see all my trades going back for the last 3 years, you can head over to spytradernow.com. There'll be a link down below. Also, if you want to sign up for my real-time trade alerts so that you receive them as I send them out, you can do so at spytradernow.com. Here is our equity curve for our model portfolio year-to-date 2023. Here is the equity curve of the SPY buy and hold investor for year-to-date 2023. And here are the two equity curves combined, because we want to compare ourselves against the benchmark of the buy and hold investor of the S&P 500. Again, our goal is for our portfolio to beat their portfolio, and currently we're not doing that. But the market is correcting right now, and last week the market came down, whereas our portfolio rose up slightly. So we'll see what happens as we move forward here. Here, the last interest rate by the Fed Chair Jerome Powell was made on May 3rd, 2023, 25 basis points, bringing your the Fed's fund rate to 5.25. On June 14th, the Fed skipped that rate hike. The next announcement by the Fed will be done on July 26th. Will we have a 25 basis point rate hike? We will have to wait and see. Now we're looking at things from the presidential election cycle theory, which states that depending upon what year of the election you are for the current president will help you determine how much market return to expect during that year. Currently, we're in the third year of President Joe Biden's term, and there's a historical average of a 16% return during the third year. Currently, the SPY buy and hold investor is up 13%. So with this strategy in mind, then we have about 3% of gain more to go before the end of the year from the SP 500's current position of market action that we can still go up from here. So just want to keep that in mind as we look at our investing. Now we are looking at things from a bond market outlook, and the bond market is saying to stay out of the stock market because of two factors. Number one, we have an inverted yield curve. Well, what's an inverted yield curve? That means when your longer term treasury rates are yielding a lower yield than the shorter term 3-month and 2-year yields. This is called an inverted yield curve. It's not normal. This will correct hopefully within the next 12 months. And at that point in time, the market will be in a healthier position. But right now, the bond market is saying the future looks less prosperous than where we are currently at, and that's why we have an inverted yield curve. In addition to that, we also have rising interest rates. 1 year ago, the 10-year yield was at 3.31. Today, the 10-year is at 3.74. That's a rising interest rate market environment, which is less favorable for equities. Now we're looking at things from a valuation standpoint. By the way, all the links for everything that I'm showing you will be in the description down below for all the pages. According to CMV, the current valuation on a PE ratio for the S&P 500 is 50.8% above the modern average of 20.2. We're currently at 30.5. And that brings us on a standard deviation chart to 1.3 standard deviations. So from a valuation standpoint, that is not exactly a healthy environment. Now, keep in mind that it's difficult to put your investment capital with just this one factor alone in mind, because you can be at an overvalued position for long periods of time. There's a lot of years here that you can be in a very overvalued position, and even over by more than +2 standard deviations that we saw over here in 1999, where just crazy valuations, and just more recently even in 2020. So currently we're here at the +1 and we're heading north towards the +2. So I know that's so the risk levels are increasing as this goes up from a valuation standpoint. Now we're looking at things from the CNN Fear and Greed Index. Currently we're at 74. Last week we were at 79. Here is our friend Warren Buffett, the sage of Wall Street. And we just want to keep an eye on this, but compared to last week, greed came down. Now we're looking at things from a seasonality standpoint. This bar chart right here is 20 years S&P 500, and it shows you the months in which the S&P 500 closed higher than when it opened. We're currently in the month of June. It's the second worst trading month of the year, but we have a 60% probability of closing higher. Currently, the month of June is up 4.06%. Here we are with this candlestick right here. Because it's a clear body, not a red body or a solid body, we know that we opened the month here, and we are currently at this trading level right here on the candlestick. So we have plenty of room that this could drop and still be a profitable month for the S&P 500. We could drop 3-point-something%, or you could drop actually 4.0% and still be up by 0.06, because it doesn't tell you how much of an increase you have to have here. It's just that you're going to be more 60% more positive when you close than when you opened the month. Now we're looking at things on a long term. This is a 20-year monthly chart, S&P 500, nice bull run 2009 all the way up to 2022. downward trading channel, broke out above it, and has not looked back since. On the thumbnail, you can see that we are shooting to the moon, which is an unsustainable curve, or that angle is just an unsustainable angle. So we know that that's going to come down and start doing the funky monkey here. But right now it's heading north. So we're going to be in a bullish condition as long as we stay above this support line from a long-term perspective. We're keeping a close eye on the MACD crossover, which has not happened yet. Slow stochastics is already positive, just keeping an eye on that as well. Now we're looking at it from an intermediate term outlook. So this is a weekly chart. So each one of these bars represents 1 week's worth of action. This is going back 5 years for the S&P 500. And nice bull run, nice steady up run. Now I put in our resistance lines and our support lines once they crossed up above them here, and we've already broken above this line, and we were coming towards the 450 but never reached it. We started to back off. So it's possible that we can back off, come down, touch a support line, come back up, and then come down for a greater correction. We're just watching the market to see how it's going to react in this environment. Now we're looking at a 1-year chart, daily bars, S&P 500, and here is where I put in that correction of where some support lines to see how much the market is going to pull back. My expectation is 3 to 5%. So at 425 is when, approximately 425 is when I want to be notified, and I'll show you that later on in the presentation. MACD has just crossed down, getting ready to cross down below its signal line. Slow stochastics already crossed below its signal line. So the market is in pullback mode right now. Now we're looking at the same chart, but instead of going back 1 year, we're going back 6 months. Also, I threw in Fibonacci extensions, and I grabbed it from the last run up that we had, grabbing it from here to the top here. Now, normally, when you have a nice run up, you're going to pull back on the Fibonacci extension 38 to 61.8%. That would be a very normal and even healthy pullback. If you start going beyond the 61.8, then that would be considered less healthy for the pullback, and it's possible that the market has reached a turning point. So what we don't know, all we know is that we're in pullback mode. We're waiting for the market to show us how much of a pullback this market is in. I'm putting in my emphasis at the 50% retracement, which brings us to right about the 425, 426 level. Also, right in this sticking range where there was a bunch of trading. So I think it's going to come down and stick there before it either breaks down or finds its support and breaks back up. We're watching the market to see how it's going to react when and if it reaches this market. If it does, when and if it reaches this level. If it doesn't reach this level and it bounces at the 38.2 and then begins to go north, that tells you the strength that this market is in. So we have to observe to see what the market is going to tell us, how confident and strong it feels on this pullback right now. Now we're looking at a ratio chart of the RSP, which is the equal weighted S&P 500, compared to the SPY, which is the normally weighted S&P 500. So, and I also threw in here 2 more graphs. The chart of the S&P 500 is in blue, and the RSP is in this lime green. The ratio chart is the black and red lines. Now, the black and red lines, which is the ratio chart, has fallen off of a cliff from this point right here, which means that when you look at that, that means that the S&P 500, the denominator, is what it's doing is that it is far exceeding the numerator, the RSP, and that is why it's fallen off of a cliff. Now, we've done that a couple times here in the past, and each time we've done that, the S&P 500, which is in the blue line, has also fallen off of a cliff here, and you can see that it's fallen off of a cliff here as well. right around the same time that the ratio chart has fallen off of a cliff. But here, where our current market environment is, we have not. As we've been in a healthy bull run on the S&P 500, no pullback, no falling off of a cliff at all, which is quite remarkable, I must say. So we are watching this, because if we start to come down, it's possible that that can have a very healthy correction. So we want to see how exactly the S&P 500. We're very careful to watch this. We'll feel more confident once the MACD crosses above its signal line on this chart of the health of this market. But until then, there's a possibility that we could fall off of a cliff on the S&P 500, like we have done so in the past 2 times over this long 20-year chart, ratio chart. So we're keeping an eye on that. Now, keep in mind that when you come down and you fall off a cliff off of the ratio chart, like you've done here and here, there's a bottoming process that lasts about 6 months or so, here and here. And then once that ratio chart starts to go higher, meaning that the broad market is now outperforming the S&P 500 normally weighted, once you start doing that, that is a healthy condition that even the S&P 500 is in a very strong position to move forward. So even though we invest in SPY, we want to know exactly what's going on from the equally weighted to the normally weighted. Now, obviously, we have not come up on the ratio chart yet. But when we do come up, that will give us a like clear blue sky signal that, okay, we can take on more leverage without having the risk that we feel that we could potentially fall off of a cliff, like what happened here and here. So this is a precarious time for the S&P 500. So we want to keep a close eye on this and make sure that we exit positions that don't hold support levels. So we definitely want to keep an eye on this. Now we're looking at the VIX volatility index, or the fear index. And here we were trading in this conservatively low range, and we have broken down below it, and we have not come back up, meaning that from the VIX standpoint, we're in a low range here, that the market should continue to rise up. If the VIX starts jumping up, breaking into this range, and if it starts getting above this line right here, and then we know for a fact that the fear is increasing, and the volatility, which is usually code word for meaning the S&P 500 is coming down, because the VIX works inversely of the S&P 500. When the VIX goes up, the black line, which is the S&P 500, goes down. As an example, here you can see that the VIX was trading here and went over to here. During that time, the S&P 500 went from here all the way down to here. So that was a very healthy correction for the S&P 500 when the VIX was in this rising environment. Right now, the VIX is not in that rising environment, hence buy the dip mode, because the VIX is not proving to us that we need to be fearful of that the dip or the support levels aren't going to hold. Right now, the VIX is telling us that the support levels should hold until it doesn't. Now we're looking at a 1-year chart of the S&P 500 on the Think or Swim platform, where we can put in the standard deviations of +2 and -2 in gold, +1 and -1 in pink, and the medium point is this dashed green line. We know that we're in a bullish condition just by simply looking at the dashed green line from the left-hand side of the chart to the right-hand side of the chart, and as long as it's going up, we know that the S&P 500 is bullish. It's going up over the last 1 year. We did not reach the +2 standard deviation. We came up towards it. This is also what was telling us that we needed to put that in the money covered call. We were expecting a pullback due to our closeness of how close we were to the +2 standard deviation. So this chart was used to help us determine, or help me determine, that putting an in-the-money covered call was a prudent bet, because at that point in time when the market corrects, I'm going to get that premium at that nice high level, because when you sell the covered call, you pocket the premium immediately when you sell the option. And when this comes down and comes to some type of a support level, possibly this regression line or a little bit higher, that's when I'm going to buy to close it and pocket that difference. Now we're looking at the same chart, but instead of going back 1 year, we're only going back 3 months. Also a bullish chart. Why? Because the chart is going north when you look at the left-hand side of the chart compared to the right-hand side. Here on this chart, we went just above the +1 standard deviation before we came back down below the +1 standard deviation. We're currently at the midpoint. I have the platform set up to send me an alert. Once we reach the 426 level, I'll get notified on my cell phone, and I'll see what the market is doing at that time. That is going to take us pretty close to the -1 standard deviation, which is kind of like right about here where we were before. Now, could it still continue to drop down? Sure, it could. But I'm just going to be notified. I'm going to take a look at the market and see if what I want to do here at that level. I have just given you a ton of information in this presentation. Now, with that, what are we going to do with that information? Now comes the critical thinking. Well, as of June 24th, 2023, market summation according to me, your host Ken from SPY Trader Now, I already have an in-the-money covered call play in place. So I'm just going to see what's happening. The market is pulling back, and we are waiting for a deeper pullback to buy to close our call option. By the way, that goes to show you how strong this market is. The pullback has been nothing. It's been 1.5%, 1.4% last week, nothing. So I'm going to evaluate the market action at that time when we come and continue to pull back, which is my expectation, to determine my next steps. So that's it. I hope you got some valuable information out of this episode of SPY Trader Now. If you have not done so already, go ahead and hit that subscribe button, ring that bell to be notified, and help me promote this video by smashing down that like button. I thank you, and I wish you good trading.